Good morning on this rainy, it's always the weather for me. I'm always looking out my window here. Um, Good morning on this rainy Tuesday. Thank you for joining. My name is Erin Ellis, and we're going to get started in about 2 minutes. Usually 10:02 is the magic number here for folks to log in. So we'll get started in just a minute. Great. And while we're waiting to officially start, I just want to point out a couple of things. First, let me put the captions on. There we go. There are handouts right in the dashboard for GoToWebinar. So if you want to take a look at those, you can have access to the resources that we're talking about today, and I'll be referring to throughout the webinar. You also will have a copy of the PowerPoint if you wish to have either of those. You can open it up, save it, and have it for this. We will not be sending it out after the webinar, so you will just have access to it there. All right. And it is 10:02, so I'm gonna get started now. We have a lot to cover today. Thank you so much for joining. My name is Erin Ellis, and I'm the financial educator and counselor with the Philadelphia Federal Credit Union. Today we will be joined by Kelly Owens, who is a mortgage trainer for PFCU, and more about Kelly in just a minute. So super excited to have her here with us today. But while we're sort of letting folks get in, I'm curious to hear from you. And I also like to use these polls for a little interaction. So I'm going to launch a poll. And I want to know, is this your first time attending one of our webinars? So you should be able to answer yes or no in the poll question. Let me know. All right, a couple more seconds. Oh, Kelly's here already. Wonderful, Kelly. All right. Looks like a lot of folks have already voted. So tons of new people today, which is wonderful. So thank you all for being here. You can see, most folks today are new, which is great. So little bit of housekeeping. Again, we have a lot to cover today. So my name is Erin Ellis. I have worked as a financial educator and counselor for PFCU for just about 7 years now. Almost 8, maybe, I don't know, 7 or 8. Prior to my work with PFCU, I worked in the social service nonprofit sector, and that experience has informed my point of view when it comes to how I talk about personal finance, realizing that how we handle money can't be separated from our social and emotional experiences. Additionally, my background is not in finance, which means I approach these topics in ways that hopefully are easy for any level of financial knowledge to understand. And then I do want to introduce our guest. I'm so excited that Kelly Owens is joining us today. So welcome, Kelly. And prior to joining PFCU, Kelly Owens, who is a mortgage trainer for the Philadelphia Federal Credit Union, she held mortgage processing positions at various lenders. In fact, her career in this industry began in 1999. She spent time exploring different opportunities in the mortgage industry before leaving the industry in 2008 during the uncertain and tumultuous times of the mortgage crisis. However, in 2010, she found she was missing the family feeling of a credit union and found her way to Philadelphia Federal Credit Union. Kelly has worked in many departments within PFCU. She started in account services, worked as a loan processor, and in 2012, she found her way to our mortgage department, where she's been ever since. Over her 10 years in the mortgage department at PFCU, Kelly has held multiple positions, including loan processor, loan originator, underwriter, assistant manager, and now mortgage trainer. So she really is extremely knowledgeable in so many different areas. Of her work, Kelly says, quote, "The mortgage industry can be a very crazy place to work, but I love my job and what I do. The best feeling in the world is getting to know our members and helping them become homeowners." And on a personal note, Kelly worked with me when I refinanced my mortgage with PFCU, and I will say it was a complicated refinance, and she was amazing. So since then, she is my go-to for all questions mortgage related, whether they're personal or professional questions. So Kelly, thank you so much for being here today.
Thank you for having me.
So excited, truly. Great. So a little about PFCU. We're owned by our members, like credit unions are owned by our members. We're typically not charging the amount of fees associated with commercial banking. The profits we make are returned to our members in the form of lower fees and better rates. Quick disclaimer here, the information provided in this session does not and is not intended to constitute financial advice. Instead, all information, content, and materials presented are for general information and education purposes only. Much of the information I have today that you'll see on the slides that I'm referencing, a lot of it comes from the Consumer Financial Protection Bureau or the CFPB, and I will talk about them more today. They have really useful and practical tools and information that will connect you back to local resources when appropriate. The information that I'm sharing today is not specific to PFCU. The idea is this information can be applied generally to purchasing a home wherever you are, right? Hopefully you also decide PFCU is a good fit, but in general, this information will be able to be applied wherever you are. All right, last little housekeeping. Everyone is in listen only mode. You do have the handouts on the dashboard for control panel. So you should see it says handouts and mine says 2 of 5. There are 2 PDFs there. One is the resource guide that we'll be looking at today. The other is a copy of the PowerPoint presentation. So this is the resource guide. And that is Home Buying 101. homebuying101.pptx is a copy of the PowerPoint slides. If you have a question or want to communicate with either me or Kelly at any point in the webinar, just write your question into the question box and we will be able to address them. We will have several points today that we're going to stop and take breaks for Kelly to answer questions. All right, so another poll here. It should be under, I think folks are still looking, if you're still looking for the handouts, mine says handout and it's under handouts. I don't know, mine probably looks slightly different from yours. If there's a problem and you can't access these, the financial education at PFCU inbox is a great place to request anything, and I'll put that in the chat. And I'll mention it again. So if you need any of these documents and you don't have access to them now, financial education at PFCU, if you email, we will get those sent out to you. Okay, great. All right, so another poll here. This is just where we're going to sort of check in and see where are folks today. So I want you to let me know, select one or more of the following. So you should see the poll here. And, you know, are you ready to buy? Do you have 2 years of regular steady income? Is your income reliable? Do you have good credit? And I mean by good credit, we'll get into this, rates in the mid to high 700s. Do you have just a few long-term debts like car payments? Do you have saved money for a down payment? Can you pay a mortgage every month? Can you pay other costs like insurance and taxes? Can you set aside money for other costs of home ownership like closing costs, moving costs, new furniture, repairs, and home improvements? And are you already, able to save for an emergency? And with these questions in mind, I want to say, and this, I start with this intentionally. The idea is that you are here because this is a work in progress. And I don't want you to be discouraged by any of what we're talking about today, because this is all about preparing to do that next step. And research shows that people who plan carefully for big purchases like a home are much less likely to have financial trouble later. So by being here, by taking this time and investing in yourself in this way, in this education, you are actually making, setting yourself up to be more successful down the road. Okay, so, and I'm gonna share results so we can see this. Most people I see need, sort of fall into these categories, need to work on that money for closing costs, down payment, and work on the credit. It's usually, and this is sort of reflected here, I can pay it. I have the income. I just have those other pieces. So thank you all for sharing, and we'll get into this a little more. The three pieces here of this home ownership puzzle that we're going to look at today are steady and reliable income. As we just talked about, looks like that's an asset for a lot of folks here. We're going to talk about those other two pieces more, though. We're going to talk a little more about that good credit and that money, and what on earth does that look like? So our objective for today is to examine the various parts of a mortgage and use that knowledge to decide what a realistic and affordable mortgage looks like for you. So this is key. What's important to you? Are you looking for that bigger mortgage, or do you want financial flexibility? I want you to be considering with these decisions and these options, what will a mortgage payment mean for other financial goals you have, like retirement, vacations, education, emergency fund? And so here is our agenda for today. We do have a place to ask questions, and it will be a Q&A throughout the session today, despite my talking here. We're going to stop after each of these sections to have Kelly, our mortgage trainer, answer questions that pertain to this topic, whichever topic is at hand. If your question is better in a different section, then we're going to answer that question later on. So we'll sort of put that on pause. If you have a personal question, it's likely not going to be answered here unless it relates broadly to more common questions. However, you can email, and I put the email address right here. If you have a more personal question and you want a more personal answer, please email the financial education email address, financialeducation@pfcu.com, and we will do our best to connect with you. The email is linked also on the resources that are shared again at the end of this session. So we're going to look at key terms with an example, and this is going to set us all on the same page. Then we're going to break down two of those puzzle pieces for a mortgage, which is credit and money. And the money is, what do I have? What do I want to have? And what's the best fit for me? So it's all of those things. Then we'll look at some next steps, questions, and resources with Kelly's help. All right, so if we are ready, Kelly, anything you want to add before we dive into our example and key terms?
No, not yet.
Okay, great. And if you are looking at questions and thinking of them as we go along, please don't hesitate to just pop it into the box as you think of it. So again, find that question box. It's open on my screen. I can see it at any point in time, and we can we can make sure we can answer that. All right. Okay. So we're going to use an example to get through some of this vocabulary when it comes to mortgages and home buying. And this is going to put us all on the same page, and we're going to use sort of real numbers and see what it might look like. So a down payment. A down payment is the amount you pay toward the home up front. Generally, the larger down payment you make, the lower interest rate you receive, and the more likely you're going to be approved for a loan, and the more money you save overall. Right? So a bigger down payment can be linked with saving money. You need a down payment of at least 3% of your target home price if you are a first-time home buyer. And a first-time home buyer is someone who has not owned a home within the last 3 years. You know, this will all just also going to say, you know, we're simplifying right now, right? I'm simplifying, but definitely there's more information to be found with the resources and the questions. So as far as down payments go, many loan types and lenders require 5% down or more. But again, you can save money if you're able to put down more. Then we have the principal. And here the principal, so we're using a price of a home at $200,000, and the median, sort of the middle number in Philadelphia for home purchase is around $220,000. So this number won't work for everyone, but I'm using it because it's kind of a middle area for Philadelphia for where we are. So in this case, we're putting 5% down, that's $10,000. The home is $200,000. So my principal, or the amount that I borrow, this is the amount of the mortgage loan that I have to pay back, is $190,000. My monthly payment will include a portion of this principal. Interest rate. So in Pennsylvania, most lenders in the data from the CFPB are offering rates at or below 5.75%. Right? So this is an average for the area. An interest rate on a mortgage is the cost you pay each year to borrow the money, and it's expressed as a percentage rate. It does not reflect fees or any other charges you may have to pay for the loan. That's the interest rate. And then we have the term, and the term of the mortgage is how long you have to repay the loan. For most types of homes, mortgages are typically, most often 30 years, but they can be 15, 20, or 30 years. So if we look at this house that we're buying, this home, that $200,000 house, I will be paying additionally $209,000 in interest, which makes the total interest and principal together over 30 years, I'll be paying back $399,000. So that house cost certainly, it's twice as much. So let's look at an example for monthly costs, right? That was sort of the overall. Now we're going to zoom in a little. So we're looking at the total monthly home payment is more than just your mortgage. There are more expenses that go along with owning your home. We have the principal and interest. And in this case here, I'm looking at $1,108. Your principal and interest, or $1,108. Your principal and interest payment depends on your home loan amount, depends on your interest rate, and the number of years it takes to repay the loan or the term. There are a lot of principal and interest calculators available online. PFCU has some excellent financial calculators, and they are linked on your resource guide. Every month, you pay a portion of the principal and interest. So with this example, in month 1, I am paying only $197 towards the principal. $910 of that payment is going towards the interest in the first month. Mortgage insurance is another cost that will be in my monthly payment, my monthly expenses. Mortgage insurance also known as private mortgage insurance or PMI, you'll see it written all three ways, protects the lender if you fall behind on your payments. Mortgage insurance is typically required if your down payment is less than 20% of the property value. So in this case, they're automatically adding this mortgage insurance every month to my payment. And that's because I didn't put 20% down. I only put 5% down. Then we have property taxes. Property taxes are based on the value of the property being taxed. Often property taxes are collected within your monthly mortgage payment. And then they're paid to the city one or more times a year, and that's called escrow. That's an escrow account. We'll talk about that in a second. We also have homeowners insurance. Homeowners insurance pays for losses and damages to your property if something unexpected happens, like a fire or burglary. When you have a mortgage, your lender wants to make sure your property is protected by insurance. So it's generally required that you provide proof to your lender that you have homeowners insurance. So this isn't the same as mortgage insurance. Homeowners insurance protects you, mortgage insurance protects the lender, but these are both additional costs. In fact, I had never heard of private mortgage insurance when I went to close on my house and was surprised with that additional cost. Now, I'm sure it was in the paperwork and beforehand that I apparently didn't look at closely enough. All right, so I mentioned escrow. An escrow account is set up by your mortgage lender to pay certain property-related expenses, like I mentioned, property taxes and homeowners insurance. So this portion I'm paying along with my principal and interest, and my lender is going to make sure that those bills are paid. So I'm paying the principal and interest, the mortgage insurance, property taxes, homeowners insurance. All of that added up together is my total home payment for the month. And in this case, that home that cost $200,000, my monthly payment is $1,546. Okay, that was a lot. So we're going to pause here for questions and give Kelly a chance if there's anything she wants to add or folks have questions. Please write them into the question box and let us know. Excuse me. The dog really likes when people come to the door. So please, feel free to add questions anywhere in the question box if you have them, and Kelly will be able to answer that. Kelly, is there anything that I mentioned that you want to add to?
So just in reference to the escrow for the taxes and insurance, if you do not put 20% down, you are required to escrow your taxes and insurance with your mortgage payment so that your lender can pay them annually or whenever they are due. So if you were to put down 20 plus 25%, 20 or 25% down, you do not have to escrow your taxes and insurance. However, if it's less than 20%, the lender is required to collect those escrows and make those payments for you.
Great, thank you for that. I didn't know it was required. Okay, so we have a couple of questions now coming in. Folks are no longer being shy. Someone asked, if your mortgage term is 30 years, are you able to pay off more principal sooner if you have it?
Yes, you can. There's some lenders do have prepayment penalties. PFCU does not. So if you wanted to pay an extra $50 and apply it to your principal every month, you can do that, and you can pay it off sooner.
Great, and that will also give you a savings in interest too.
Correct.
Which is great. So someone asked, are all of the things listed required to own a home? We'll go back to that.
So I'm not really sure what exactly you mean in reference to that, but yes, so you have principal interest that has to be paid. If you have less than 20% down payment, mortgage insurance is required. And the same thing, if you're going to escrow your taxes and your homeowner's insurance, your property taxes and your homeowner's premium will be collected in escrow.
Thank you. Yeah. And you know, if you put, yeah, the PMI, I guess, would be something that, but here's another good question. I'll ask Kelly and then you can talk more about this. The question is for PMI, how does it work with conventional mortgage versus FHA?
FHA, if you have PMI on an FHA loan, the PMI mortgage insurance stays on there for the life of the loan. Now, if you are doing a conventional application and you have private mortgage insurance, if you have had the loan for at least 2 years or paid down to 78%, there is a process where you can request to have your PMI removed.
Okay, great. All right, give me a sec here. There are a lot of good questions. Can you just let us know what is FHA? It's a federal agency. And a certain type of mortgage, right?
Hold on, sorry, my computer froze.
Perfect timing. All right. See, so another question, while Kelly's getting up and running again, is there a penalty for paying off the loan before 30 years? As Kelly mentioned, there is for certain loans that will be in your paperwork. And she did mention at PFCU, there is no penalty for paying your principal off early. Someone just asking to explain a little more about escrow, how it works. And Kelly, please interrupt if you're ready. Otherwise, I will just continue to sort of answer questions I'm able to. Escrow is like a separate savings account that they hold for you. Your lender holds for you. So every time I make my monthly payment, they take, you know, $300, $360, put it in a savings. And when my bill is due for my property taxes, my homeowner's insurance, then they take that money from the savings. So it's just, you know, simply a savings account that the lender holds and uses when they're ready.
Okay, so sorry, my computer froze, but I still have audio. So, you asked what FHA was?
Yes.
Okay, so FHA is basically it's a federal it's a government-backed loan. The program is based to help borrowers that may have like a lower credit score. FHA allows a larger down payment. A seller assist, meaning the seller can assist with some of your closing costs. Where conventional, there's a little bit more restrictions. So the idea is that the program is to help first-time home buyers get into a home. Normally, you know, you may not have as much funds as required for a down payment for conventional, and maybe you have a little bit of a rocky credit history.
Great, thank you. Okay. So then follow-up for that, is it better to go through FHA if you qualify?
It really depends. So when you are looking for a home, it is okay to shop around. The costs for FHA are a little bit higher versus conventional, but if you were putting down 3% on it for an FHA loan, you can get 6% seller assist. If you were putting 3% down on a conventional, you're only allowed to get 3% seller assist. So you kind of have to look at the differences in the cost of the loan to see what is more beneficial for you.
And I think I'm going to just repeat what you said when you said shop around, right? So looking at those options and what that means. Can you explain seller assist?
So seller assist is a credit that the seller can give you to go towards your closing costs. So let me get my calculator up here. We were working with a $200,000 loan. If you went conventional, you could get $6,000 credit from the seller at closing to help pay for your closing costs.
Does the seller have to agree to give you that money?
Yes, they do. So
All
if
right.
you were to go FHA, you could go up to 6%. So they could give you up to $12,000 seller assist. Now, if your closing costs were only $10,000, you're not going to get $12,000 in seller assist. You would only get up to your closing costs.
Okay. Just like one or two more questions here. Someone asking about employment. So this is slightly different. Is it possible to try the process if you haven't been at the same employer for 2 years but have no gaps in employment?
So the idea is that they want to see consistency. So they like to see a 2-year employment history. If you have, career advanced opportunities and you've changed from one job to another to, increase your salary, advance yourself, that is fine.
Great, thank you. A question about student loans, and we'll talk about those, I think, a little later on. So we'll pause that one. I'll keep that there. So we will come back to it. Someone just saying too, and I don't know, I guess there is a question, saying what I think maybe many of us are thinking if we've been paying attention to interest rates. Certainly, I updated these numbers yesterday, and it also blew my mind, but they said these new interest rates are mind-blowing, but couldn't agree more. I know credit scores play a huge role. Are there any other factors on my end that would help with decreasing the average rate?
So different lenders offer rates at a different, we start with PFCU starts with a base rate. If our rate today is, 5.75, and we take a look at your credit score and it's a little bit on the lower side, because there's higher risk by looking at your credit history, they may increase your interest rate. Okay. If you are putting minimal down payment, that is another risk. So that could also affect your interest rate. The way to reduce your rate is by buying what they call points. So you pay 1 point, which is 1% of your loan amount, to reduce your interest rate. So basically you're paying for a lower rate. And there's really, it's no benefit. I mean, the benefit to you is that you're going to get the lower rate, but that money goes to the credit union or whoever your lender is so that they can offer you a lower rate.
Sounds, I don't know, stressful. No, thank you, Kelly, that's great. And I think, knowing that if you have these pieces that we're talking about that Kelly mentioned, we're looking at credit as a way to give you the best rate possible. And then it sounds like money, right? There are different ways that you can use your money that will lower the costs. The other thing is, yes, interest rates right now are a lot. So it's something to consider, but there are options as far as, you can make additional principal payments if that makes sense for you, but you don't want to neglect savings and other goals either. So, it's a lot to consider, not to mention the market right now. The housing market is, homes are very expensive right now. And so you have to be cautious to make sure you're really getting, is the value there for you?
And just to add to the rates, I mean, yes, everybody is saying 5.75 is high, but that is high because we just recently saw an all-time low in interest rates. When I purchased my home back in 2010, the average rate was 5%. So it's not astronomical like in the 80s when they were at 10 and 11%.
17 for my parents.
See? So it could be worse.
Yes. And, you know, mine also, I bought mine at 5.25. And then, like I mentioned earlier, the rates significantly dropped and I refinanced at 3.25 for 15 years. So not to be too technical, but, you know, there are options potentially. But, you know, all of this continues to, your options will continue to require good credit and money. Right? So like I had those options because my credit was good and I could afford to refinance, which doesn't, you know, which is not always, again, we don't need to get into that. All right. I think we're ready to move on to credit because I think we might end up getting too many detailed anyway. I think this is a great place to move on. Okay. So talking about credit. Now, you know, we've established the context for the conversation about monthly costs and overall costs. I'm going to give you the bad news up front. And this is really important when it comes to rates. We're going to look at this. If your credit score is below 700, and this is according to the Consumer Financial Protection Bureau, so this applies across the whole country. If your credit score is below 700, you will likely pay more for your mortgage. So if you work on improving your credit and wait to buy a home, you will likely save money. So just because you can be approved doesn't mean it's the right thing for you. I want to mention, be careful when making any big purchases on credit before you close on your home. So if you're in this process, financing a new refrigerator, anything you do with your credit could make it harder for you to get a mortgage. I also want to mention that correcting errors on your credit report is a great way to see improvement in your score, and we'll talk a little more about that. Definitely another thing you want to do before you apply for a mortgage. And a third thing is that you will want to make sure that if your credit is frozen, if you have a freeze on your credit report, that you lift that freeze before you apply for a mortgage. And if you don't understand that, come to my credit webinars and we'll talk more about what a freeze is. Probably if you don't know what it is, it doesn't apply to you. But if you do have a freeze on your credit, make sure you lift that before you apply for the mortgage. So let's look at the cost of credit and the cost of interest. So this is from the Consumer Financial Protection Bureau. These are rates based on Pennsylvania averages. And you can see, if you can check out this slide, you know, we have my home with this down payment that we've been working with this whole time. We're going to explore what a lower interest rate means for your wallet. Over the first 5 years, we've got the interest rate of 5.75% versus 6.25%. So potentially that 6.25% has a slightly lower credit score. The cost for that 6.625 is $8,000 more than an interest rate of 5.75 in the first 5 years. Over 30 years, the difference in cost is almost $39,000. So you can see what a huge difference that interest rate makes, which is why credit is a really important factor. So we're going to start with credit by checking for errors. Make any corrections before you apply for a mortgage. There are 3 major credit bureaus that collect all of our credit data: Experian, Equifax, and TransUnion. There is one place to check all three every week, and that's annualcreditreport.com. It is linked on the slide, it is linked in your resources. You can find it linked through our website. We are now able to access our credit reports every week, and that's a change that happened during COVID. And that's a great way to take a look at your credit, and it is free. Checking your own credit has no impact on your score. Lenders use your credit scores and the information on your credit report to determine whether you qualify for a loan and what interest rate to offer you. So you want to get copies of all three of your reports. Check your reports carefully for errors, any debts or credit cards you don't recognize. Linked on the resource guide is a credit report checklist from the Consumer Financial Protection Bureau. So this walks you through reviewing your own credit report and helping you find the direction to correct any errors or filing disputes. Credit scores. What do we mean when we say good credit? So again, credit score is only one factor in a lender's decision, but it's an important one. So this is from the Consumer Financial Protection Bureau, right? This is not the PFCU guidelines, but this is in general what most lenders will fit into these categories. You can learn more options for getting your credit score. Now, credit scores are often not free, so we can't access it through annualcreditreport.com. That's just the report, which is all the details. But your score, you can get it by checking your loan or credit card statement. You can also see a certified housing counselor, which we'll talk more about in a moment. And there is a resource guide connected with the CFPB about where you can get your score. So I have a resource for that. Most mortgage lenders use FICO scores. What do you need to know? And FICO is just a company that creates the score and they sell it, right? What you need to know is that credit scores range from 300 to 850. Higher scores represent a better credit history and make you eligible for lower interest rates. Most mortgage lenders look at FICO scores from all three companies and use the middle score for deciding what rate to offer you. If you're applying for a mortgage jointly or with a co-borrower, lenders look at both of your middle scores and use the lower one. So if you're buying a house with someone else, both of you have to be thinking about your credit. The rate you are offered on a mortgage can vary quite a bit depending on your credit score, which we just saw on that last slide. And while there are no firm rules about exactly how your credit score affects the interest rate you may be offered, in general, the best rates go to borrowers with credit scores in the mid to high 700s or above. So these borrowers typically also have the most choices available to them. They will be able to choose between different types of mortgages and different homes, right? Borrowers with credit scores in the high 600s to low 700s typically pay somewhat higher rates. Borrowers with credit scores in the low to mid 600s generally pay the highest rates and have the fewest choices. Borrowers in this range may have trouble qualifying for a loan, depending on the loan type and depending on the lender. So you might not have as many choices. And then borrowers with scores below 600, it's recommended that you work on your credit before applying for a mortgage. So what if you need help with your credit? PFCU has a relationship with Clarify. And there's always one or two people who share in the questions how they have had a great experience working with Clarify. So Clarify is a local nonprofit financial counseling agency that is a partner of PFCU. Clarify counselors will work one-on-one with you to understand your unique situations, challenges, and goals. Based on that information, your counselor will work with you to create a step-by-step action plan. It's custom roadmap for you. Most of what Clarify offers is free. They are a nonprofit. That means they're not making money off of you. They have been established in the Philadelphia area for a long time, like 70 years. I don't know, something ridiculous. And they have a great reputation for really supporting and helping people along these processes. So I can't encourage you enough. If credit is something that you checked at the beginning or you didn't check because you are not quite there yet, please call Clarify and schedule an appointment for that one-on-one free credit support, credit counseling. They are an outstanding resource, and I truly cannot recommend them enough. You see their information here, and you'll see it in the resource guide. You'll see it again on the next slide. So credit next steps, and we're about to have a question session here with Kelly. You know, you want to check for errors on your credit report and file disputes. Clarify can help with that. Build credit, pay down debt, and get free credit counseling from Clarify. You know, we don't need to do everything ourselves. So it can be great to have that resource and have that help from an expert who is not charging you. Okay. All right. So we're going to have a break for questions. Make sure that I addressed everything I wanted to.
And Erin, I want to add to that in reference to the credit score. As Erin stated, PFCU, most lenders use the FICO score. I know that Capital One, I think Credit Karma, Discover, they offer you a credit score with whatever subscription you may have with them. That is not necessarily the FICO score. So if if the score you're receiving says it's a 650, that may be based off of a stimulus that they're trying to calculate if you make all of your payments on time, reduce your balances. It's not exactly what your score is. So that is something to keep in mind when you apply for a mortgage.
Thank you, Kelly. And linked on your resources, we have recordings of the webinars about credit, and you have links to other resources. All right, let's see what the questions are here. Is it, oh, well, and I'm gonna be teasing a little here, but this question wants us to read the future here. Is there a chance for lower interest rates and home costs in the near future?
I hope so. It's really hard to determine what's going to happen in the market today. I absolutely, hope that the housing market does change and the value, the prices and costs of these homes go down. Some of the purchase prices that I have seen over the past few months has been astronomical. So for a first-time home buyer, if you've been saving money and working on your credit and you're looking to put maybe 10% down, it has been really hard in the market to find a house because a lot of people are offering paying more than what the purchase price is, things that are not really realistic for a first-time home buyer to do. So I mean, there's hope, but unfortunately, no, we cannot predict change.
Thank you. All right. What other questions about credit do we have? Please,
I did see a question about student loans.
Yes. Oh, yeah. Great. We can talk about DTI.
Let me go back to the student loan question first.
I can read it to you. Where did it go?
I would say, can you start the process if your student loans are in deferment? You can apply for a mortgage when your student loans are in deferment. However, The requirement is we have to use 1% of the balance to calculate your payment. If your balance is only $3,500, then that's $35 a month. Not a lot. However, student loans get to, they build up, and you could have a $100,000 balance. So using 1% of that would affect your qualifying greatly. The other option is many of the student loan offers a fully amortization of payment. So if your student loan is $50,000 and they said that they're going to give you 25 years to pay it back at a certain rate, you can provide us with that information and the minimum payment, and that's what we would use. Unfortunately, we cannot just accept that they're in deferment, because eventually you will have to pay them back, and we have to consider that. If you're on an income-driven payment plan and it states that your payment is zero, we can accept that. But we need documentation of all of this, and it would need to be reviewed.
Great, thank you. Yeah, and student loans are, many people. While we're talking about student loans, later in the summer, I will be doing a webinar on options for paying back student loans. I think if there is enough interest, I might also do one focused just on the public service loan forgiveness for those who qualify for that. So stay tuned. Okay. So how might being a co-signer for a family member impact your credit lending worthiness?
So in this case, PFCU doesn't have co-signers, they're co-borrowers. So you are equally liable for the loan, just like the borrower.
So then if you do that for someone, that will be a part of your personal debt.
Correct.
You are trying to buy a home later on. So it will have a huge impact, potentially, on your. Someone wanted to know if sellers have the option of not accepting FHA loans.
Yes, they do. They can turn your offer down because you're only putting down 3% and somebody else is offering 20%. They do not have to accept the offer based on the terms that you are offering them. FHA, VA, they can decide that they do not want to accept any offers based on those programs.
Do you think, Kelly, this is a good place to talk about DTI? I can show that video. That's quick.
Okay, yeah.
And if not, that's okay. Truly just want your expert. All right. We'll pop that up because there was another question on student loans too coming up. They asked, if you have a high student loan debt, is it best to wait on buying?
So it really depends on your total debt. So if you only have a student loan and you make a certain amount of money and now you're going to add a mortgage payment into it, what we do is we calculate a debt to income. Basically, that is all of your monthly liabilities, including the new proposed mortgage payment, and divide it by your gross monthly income. Typically, we like to see that be around 43% max.
All right, so I will share, it's, I think, 2 minutes, a little more about DTI. And then we're gonna press forward. Okay, so the audio for this video will come out differently on your speakers. You might have to turn up volume on your device, but it will be going now. I apologize that there is no captions for this video if you cannot get the volume to work, but I can link it for you in the chat so you have access to it later. Okay, so just a little more or potentially less information than we had a moment ago about that. Hopefully, it's another factor, right? The DTI. So there's no easy answer for any of this, right? And everybody is going to look different based on their personal situation. We're going to get into that next about our personal financials and what's going to make sense. So that's going to be our next section here. There was a comment here in the chat, the last one I'm going to mention for now, and then we'll have another session of questions. They said, I have everything that you're talking about. I went through the checklist and I was good, but I was denied and they didn't tell me the next steps of what to do. So for that, if you feel like, I think I'm ready, but you're not sure. And maybe even if you think you're ready and you've been denied, or you think you're ready and you don't, want to rush into this process, I can't recommend checking in with Clarify enough as a way to do that. So if you check in with them, they can sort of help you look at your full picture and see how you are packaged for a lender. Someone said they can't hear me. Hopefully, yeah, and I apologize with the video. Sometimes they work great and sometimes not. Hopefully folks can hear me. Okay. So let's look at the money, right? Many folks here said, I have the monthly income. I need that other, those other pots of money. So we're going to move on to money and we're going to draw up. So this is sort of your first step in this process, is to draw up an as-is monthly budget that accurately reflects your current spending. Don't edit your budget at this point. This is not what you could spend or you should spend. This is what you're really doing, what your actual expenses are. We need to start here. Look at your checking account, look at your credit card history for the last several months, use a spending tracker, and I have one linked on the resources, but don't leave anything out. PFCU offers a money management tool that can help you categorize and look at those expenses if you use your checking account for most of your expenses. If you make regular savings contributions to an emergency fund or other saving goals, include these in your plan. Include these in this monthly budget. Do you support family members? Include it. If you are doing seasonal or recreational costs, include it. Gifts, charities, vacations, include it, include it, include it. Just because you buy a house, you're not going to stop doing these things. Look back several months, take a look at the whole year to see if you've missed any of those frequent expenses, like maybe insurance payments, medical expenses, school clothes, tuition, whatever, right? And again, we have a webinar on this. You can watch a video. There are a lot of good resources out there for this, and I do have some on your resource guide. Well, right now you're looking at this and you're not editing to reflect what you could or should be spending. This is what you're actually spending. In the next step, we'll look at changes, right? But for now, we want to know, and we want to not leave anything out because we want to be realistic when we enter into this. All right, so now I know what it is. I know how I've been spending my money. I'm going to look at developing my forward-looking budget. How am I going to spend my money once I've bought a new home, right? So this is going to help me decide my target monthly home payment. I'm not going to just be trading rent for a mortgage. My total monthly home payment will include, like we talked about, mortgage, principal, interest, property taxes, homeowners insurance, and any mortgage insurance, right? And I know a lot of us are confident that we can pay those, right? I know what it is, I can afford it, it's okay. We also want to make sure we know what estimates, and you can Google all of this, estimate for the cost of electricity, gas, cable, internet, water. If you have homeowners association fees, include that in your forward-looking plan. Include those estimates. Your electricity might be more if your house is bigger, right? Estimate the expenses for your home maintenance and improvements. And again, you can look to the internet to sort of Google some of these averages and know what things do cost. Think about what your budget will be once you bought the home and decide how much you want to be saving each month for emergencies and other goals. And make sure you build that in from the beginning. Now, if these expenses are going to be more when you are a homeowner, which often they are, practice living with these adjustments. So, I'm going to say, all right, my monthly payment and monthly expenses and savings and everything else, it's going to be an extra $500 a month. Well, I'm going to practice by putting that $500 aside into a savings every month. And that's going to get me closer to that goal also, right, of closing costs and things like that. Now, if I go the first 2 or 3 months and I cannot commit to that saving $500, then maybe I need to readjust, right? So that practice is a great time to stop and to look at what is realistic. New homeowners are often surprised by the extra costs of owning a property. Taxes, insurance, condo fees potentially. If you have repair costs and upkeep, you might want to make improvements and upgrades. You might need more furniture because you have a bigger space. And you might not have been paying for water or trash, but now you have to. There might be parking to pay for. Commuting costs can change. Utility setup fees, buying appliances, right? There are a lot of things that you don't want to forget about that will cost you money. So again, we're going to look at some tough news, but there are always options, right? There are always options. So, we've looked at, all right, what can I comfortably afford on a monthly basis? I'm going to look at my savings and determine how much I can afford for a down payment. So we're looking at mortgage closing costs here, right? This is another cost. And this is one that there is sometimes help for, and we'll look a little at that. But mortgage closing costs are your responsibility. They're the costs that you pay at closing. And closing is when you actually get the keys and sign all that paperwork. It includes origination charges, appraisal fees, credit report costs, title insurance fees, and any other fees required by the lender or paid as part of your real estate mortgage transaction. Lenders are required to provide a summary of these costs to you in your loan estimate, so you will have a chance to look at it. But I put this up here. We talked about that down payment of $10,000. Some of these costs you can make adjustments to. Some of them you cannot, right? You might not need to spend as much on furniture. But the one I'll say, you want to make sure you have that emergency cushion. Because no matter what, you want to hold on to that house. And so, and have what you need for your family. And we're looking at closing costs as an average of 3 to 5% of the purchase price. So determine your down payment goal. Consider, in general, when you're putting your money into your home, it means it's not available for other things. There might be low or no down payment options available to you. There are special programs for veterans and service members, rural residents, some types of first-time home buyers, and others. A housing counselor, a HUD certified housing counselor, may be the most familiar with local programs in your area. There are things like First Rent Door and individual development account programs. And I have information on both of these on the resources, and I'll just pop over there for a quick second. So it's on the screen. Ooh, look at that, I was adding something. There's information on down payment and closing costs locally, right? Including First Rent Door, which is a program PFCU participates in. So there are options, and really the best place to access those is to connect with a HUD certified housing counselor. Clarify is a HUD certified housing counselor, has HUD certified housing counselors on staff, and so they're a great resource for that. You can also find others. A lot of the CDCs, the community organizations, have those, and so you can find a good fit for you, but those are a great resource to connect with those programs. Sometimes low down payment options come at an increased cost. And so when you meet with lenders, ask questions and ask to see multiple choices. But always, check in with that HUD certified housing counselor. Okay, so this is another point. We talked about this big money, but we're gonna do some questions with Kelly. So what sort of questions do you have about down payment, closing costs, or Kelly, if there's anything that you want to point out that
I just want to point out, like the First Front Door is a seasonal thing that is not always open. It usually opens up in March or April. There's only so much money allotted to be used, and once that money has been taken up, they close the program out. So as of right now, that program is closed. There are other programs that you can look for based on where you're looking to purchase. Sometimes some townships or communities offer certain things. The city of Philadelphia sometimes offers a grant. There's a lot of different options out there. You just have to look for them.
Great, thank you. And I think if you are linked in with a HUD certified housing counselor, they can help you sort of look for those strategically too, right? Like if it is a good time for First Front Door or a different program that is around. A question again, and I think we sort of talked about this, but it's a good question to ask now that we've actually looked at those closing costs. Can sellers assist with closing costs?
Yes, seller's assist goes towards your closing costs. Yes.
I just have to say,
sorry.
Yeah, go ahead.
The only thing I have to say is the only risk is right now is that a lot of sellers are not offering seller assist because that's just, that's more money for them to be able to keep. So if I go in and put an offer to buy a house for, I'm going to say $200,000, I'm going to put 20% down, that's fine. However, if somebody else goes in and asks for the same thing but asks for seller assist, that means that's less money that seller is going to walk away with. So it's not always a guarantee that you're going to get it.
Yep, thank you. That was going to be my question. Yeah, are we seeing a lot of people getting seller's assist right now? And that was
No.
no. Okay. Someone asking what's included in closing costs. I sort of did rattle off a list. They asked, is it always a certain percentage or how does it work? So can you talk a little about closing costs?
So there is no specific percentage. We usually just say, an average. What it includes is when you purchase a home, you have to obtain title insurance. The title insurance and the cost for recording a new mortgage, new deed, all of those things. The title insurance itself is based off of your purchase price. So the larger your purchase price, the higher the premium is. Okay. Those recording charges and notary fees, all that stuff, they're minimal fees and they vary slightly. The other thing included in your closing costs could be if you decide to pay any points to lower your interest rate. Your closing costs would be any fees for the appraisal, for your credit report. We also include the amount of money that we will need to start your escrow account. So that can vary based on where you're looking to purchase a home. If your taxes for a home in Philadelphia are $2,000, we need to consider collecting enough money so that when your bill is due next year for that $2,000, we have it available. If you're in some of the suburbs, the taxes are higher. So that will affect the amount of money you will need to start your escrow account.
Thank you. And when do people know how much money they'll need to have at closing?
So when you apply for a mortgage, if you do not know where you're looking to purchase, but you have an idea of where you're looking to purchase, we usually ask you for a zip code because of the different charges there are based on counties, townships, and estimated taxes. PFCU can offer you what we call a pre-application worksheet, and it kind of gives you a breakdown of the estimated fees. Once you actually sign an agreement of sale and you provide us the address and location of that home, lenders are required within 3 days to disclose to you a loan estimate with a list of the estimated fees.
Great, thank you. Okay, it looks like that's the questions for this specific topic. And let's just sort of, finish up here and then leave some more room for questions. Just want to point out, you want to make sure it's the right time for you. Not, I know lately we did have really low interest rates, so that was a good time, but it might not be the right time for you, right? Make sure, there are financial and other trade-offs to renting versus buying. Each step in this process, you can make a tentative decision based on the information you have. And then whether you keep moving or you put it on pause, it doesn't mean that you have to say you're not going to do it. It's just like today is not the day for a variety of reasons, right? Whether they're your reasons or they're reasons out of your control. So we did mention, currently people are making offers over the asking price. They're buying houses without an inspection, which is extremely risky. So, a little bit of a way to think about it here. And I think, this is something that resonated with me. If you can afford to pay for a home, if what you can afford to pay for a home isn't enough to get the type of home you want in a neighborhood you enjoy, there are other options, right? So now I know I've gone through all of my financials. I know what I can afford, and where I want to be, and maybe that's not realistic in the neighborhood that I'm looking to move. So I can consider cutting back on optional monthly spending so I can afford a higher monthly payment. That's an option. I can afford waiting to buy until I save enough for a higher down payment, right? That higher down payment will result in a lower monthly payment. Or, maybe I'm renting in or near a neighborhood that I'm interested in, making sure that is in fact worth the investment before I do that. There is a calculator the New York Times came up with, is it better to rent or buy? It kind of can help you sort of look at your personal situation based on your financials to see. And of course, it's only an estimate. There are always going to be risks associated with owning property, however rewarding it is, and as a way to build wealth. But when you rent, your landlord's responsible for the property, and your landlord's taking on those risks. When you buy, you're the one taking on these risks. Your home value can decline, which means that you will lose equity or possibly owe more on your home than it's worth. Right? So that's something to think about, especially with the high prices of homes at this time. So there are some situations that it is better to rent, and that's okay, right? So there are a lot of things to consider. What you can do too, right? The next steps here are to build a network of advisors. So they don't have to be experts, but people tend to do best when they rely on a network of trusted advisors, not just one person, to help them through the process. It can be friends, relatives, coworkers. They don't have to be professionals. Think about people you know, family, friends, coworkers, or other people you trust who have bought a home or refinanced a mortgage recently. Identify 3 people that you're comfortable with talking about this process, about the buying and shopping process. You don't need to, it doesn't need to be someone you're closest to, just someone that you think is knowledgeable and trustworthy. You don't need to share your personal information, right? Consider just asking them the questions. So that's your own network. Part of that network can be a HUD certified housing counselor, right? Check in with Clarify or another HUD certified housing counseling agency to look for pre-purchase counseling services. I also have, those resources, but Kelly shared, and I'll put these in the chat in a moment, some great help from Fannie Mae in terms of educating, in terms of helping with these questions and in this process. So, be cautious around real estate agents, mortgage loan officers. They're really important sources of information on this process, but they're not the only people you should consult, because these professionals make money based on your decisions. Their interest is not always aligned with your interests. So ask yourself many points. Does what I'm hearing make sense? So that's where that network of advisors comes into play. It can help you evaluate what you're hearing and think through these major decisions. All right, so.
Can I just add to that?
Yeah, please.
I just want to advise you that PFCU, our loan originators, do not make any money on your loan. So that is something that you want to consider when looking into a financial institution when you're going to do your mortgage. There's no commission, there's no type of payment that gets paid to staff based on your loan. So it's all about member service.
Thank you. That's such a good point too, Kelly, especially with seeing how other financial institutions, specifically banks, have incentivized things in ways that cause people to do things that are not ethical. That is something that we have built into our system at PFCU that we can avoid, which is Awesome, thank you. All right. Questions, and Kelly, anything you want to add?
We did cover a lot of stuff. I mean, the only thing that I can stress is, if you have any questions, reach out to the resources that Erin is providing you today and ask questions. PFCU, we are here to try and make sure that your home buying process is as easy as possible. It is a long process and it is very stressful. So if you have questions before getting into applying for a loan or looking for a house, reach out and try and get all of your questions answered first.
Thank you. That's a great point. All right, so question about specifics here, logistics, cash down, what does that mean? How are people actually paying these down payments, these closing costs? Are we using a check, a debit card? Do you actually get physical cash? How are we paying these big expenses here?
Okay. So your cash down is considered your down payment. Normally, when you put an offer in on a house, you have to give them a check of good faith. So depending on the purchase price, it could vary. Your first payment could be $1,000. It could be $3,000. Sometimes they require $1,000 when you put in your offer, and then maybe after the home inspection, they want an additional down payment, $3,000. Transactions are done by check. Normally, it is a cashier's check or a bank check. There's actually no actual cash in transaction. Sometimes they will do a wire from your financial institution to the title company to hold it. Okay. All funds that are used for the purchase have to be verified. Your lender or financial institution that you're getting the mortgage from is going to ask for a couple months of bank statements, and they want to see that the funds are seasoned. So you cannot take what we consider mattress money, cash that you've had at home, and I would say $5,000 deposited into your account, because it is unsourceable. We are required to source all funds. You cannot borrow money to purchase a home. So you can't take out a personal loan for your down payment. You cannot put it, take an advance on your credit card for your down payment. You cannot do that. The idea is that your lenders want to make sure that you're able to save those funds to put a down payment on the home.
More specifically, great. So this person is saying they're a hairdresser. So how does that work? I'm guessing that means you're self-employed, right? So what would this look like for someone who is self-employed?
That could be a twofold question. So self-employed, we would use your 2 years of tax returns. What you report and claim to the IRS for income is what we would use for your source of income. If you get tips, if you're a waitress, hairdresser, and you claim them and you get paid by W-2, that's what we would use. We cannot use undocumented sources of cash.
So then in that case, if you want to be using this cash, you want to make sure that it's being reported, right?
Correct.
Yeah, and sort of follow up as I have a consistent cash flow in my account, we're not really looking at, it's really about the W-2, correct?
Right. I mean, and if it's in the nature of your business and we're going to see a consistency of it, depending on the business, depending on what you're doing, and you're putting deposits into your account, that's more on a personal level. We would have a conversation based on your situation. in reference to, in reference to actual cash flow, I mean, if you're reporting it and we can document it, then we would be able to, we could use it. There are so many different scenarios. I would have to specifically see your scenario to get into further details.
Great, thank you. How do gifts fit into undocumented cash or inherited money? Should we deposit it a certain amount of time before we apply for a mortgage?
So gifts are permitted from family members. What we require is for you and the donor to fill out a document stating how much money they're going to give you for a gift. And then before you close, they will have to show proof of receipt. So either a transaction transferring it to your account, a copy of the check that they gave you that you deposited into your account. That's acceptable.
Okay. Is the rent that you're paying considered in any of this approval?
So we can do what's called a verification of rent. So if you don't have a history of, paying a mortgage, we can do what's called a verification of rent to see that you've made timely payments every month for the past 12 months.
And if that is considered, does that impact, because rent is not reported to the credit bureaus? So
it is not. It is not, but we look at it as it's kind of like a compensating factor. We take into consideration, okay, you may not have had a mortgage payment, but you've consistently been paying this rent on time, and we look at that and compare it to your new mortgage payment. Whereas if you have never paid rent before, you've never paid a housing expense, and you're going from $0 a month to $1,800 a month, that's something that we would look at considerably, because that's a large increase in your monthly obligations. However, if you've had a rent payment for $1,200 a month and you've consistently paid it, we take a look at that and compare it to, you've paid $1,200, it's been on time, you're going to pay $1,800. We take that into consideration.
Okay, great. Credit improving apps that add something you pay monthly, a good option. That question, I'm gonna say, let's put that on hold. You can email it. There are, what's recommended for credit improving. That will take us to, because we have, not much time left here. A couple things I wanna say. One is, if you have questions about credit, definitely check in with Clarify or another HUD certified housing counselor, which you can find by clicking a link right here. Also want to mention, if you scroll down on this resources, there are some webinars that I recorded about managing debt when it comes to credit, about the basic building blocks of credit. So you can check in those, but there's also some good things. I'm very cautious around that. So I would say, research first, check in. Definitely things that I would recommend, but not that I have enough time for at the moment. So these are the resources. And I do want to mention too, upcoming webinars, Saving for Children. If you're interested in talking about that and learning about that, does not just include saving for college, other options as well. If you want to know more about federal student loan repayment, and you can see I'm going to be focusing on public service loan forgiveness from 2 to 2:30. So come to the whole thing if you're a public service employee. And then Kelly and I are going to be coming back and doing a variation on this in the near future here in July. So please, register for those. They're all free, as is this, and please share them with anyone else that you think would be a good fit. Very lastly, I want to make sure to thank Kelly so much for coming today and helping out with this. Truly, truly appreciate it. Can't wait to do more. and you're on the hook now. So you were anyway, and it's 11:30, but I want to give Kelly another little boost here, because Kelly came on her own and sort of was like, how can I help our members, and connected with me in that way. So, thank you again for doing that, for really always going above and beyond for our members. And so I'm excited to continue this in the future. On that, I'm going to ask everybody, yes, people can absolutely come to our webinars if they're not members. I'm going to ask everybody here, when we end shortly, we're going to have, there's a 4-question survey that pops up. If you can take time and give us some feedback about what you want to hear about in the future, because this is, new, we're moving forward with this, please write that in. It will help us tremendously in the future and offering more and better and addressing questions and concerns that folks have. So thank you all again. Kelly, thank you so much for coming.
No problem.
And I look forward to seeing you again. Please, everybody, fill out that survey. It's super quick and it's a huge help. And I hope you enjoy the rest of your day. Take care.